Okay, we're ready to get started, everybody. Thank you for coming. I am Rick Newman with Yahoo Finance. We are here to talk about financial technology and how it can help improve people's prosperity, and we're going to talk about that from the perspective of different generations, but we'll get into that. So let me just tell you who we have here. Obviously, you can look up their bios online, their deeper bios. Mike Calhoun is right next to me. He's president of the Center for Responsible Lending. He's been working in this field for a long time. Mike, the most interesting thing I see on your bio is you have a bachelor's degree from Duke and a law degree from UNC. So does your head explode during basketball season?
Yeah, split personality.
I mean, any basketball fan wants to know, who's your team?
Usually Duke, although I'm a big fan of Dean Smith, obviously.
So North Carolina's like your backup team.
That's right. ACC.
Not sure. Aaron Klein is next to him. Aaron is a fellow in economic studies at the Brookings Institution in D.C. He's a feisty panelist. I saw him earlier this week, and he's going to be very live here. He worked in the Treasury Department under President Obama and worked on Capitol Hill in the Senate Banking Committee before that, and had some other jobs in D.C. as well. Theodora Lau is next to him. She's founder of Unconventional Ventures. That focuses on addressing the unmet needs of consumers who need the help, and specifically older adults. And then at the far left is Liz Loewy. I didn't mean to imply anything by far left. I know these are politically fraught times. Liz Loewy is Chief Operating Officer of something called EverSafe, and that focuses on protecting seniors from fraud. And she was formerly a prosecutor in the Manhattan District Attorney's Office, where she helped set up the first elder abuse unit there. So we're basically talking about financial technology, otherwise known as fintech, very trendy. So the definition, here's the definition we're working with here. For the purposes of this panel, fintech refers to consumer-facing, tech-enabled financial solutions. And to me, I think that just means apps that help you manage your money, or technology that helps you manage your money or get ahead or become more financially literate. So we'll talk about that. I will say that as a journalist, I get pitches all the time from PR agents saying, you've got to interview this entrepreneur who's developed this great fintech app. And it feels to me like fintech, it now has this sort of buzz phrase quality, kind of like crypto did a few years ago. Or blockchain before that. Obviously, there are some legitimate, important things happening here, but I'm on the sort of the lookout for sort of scammy stuff as well. So, I'm going to start by I think I'm going to start with Aaron and just say, can you define for us what is the need here? We have banks. I mean, banks offer all kinds of financial services. Obviously, they don't offer them to everybody. So, what is missing in the marketplace?
So, I take my girls ice skating on Saturday mornings, and after we go ice skating, we go to the bank, which is around the corner. It's a pretty big regional bank, and I'm sitting there in line. I do my banking. They get a lollipop. We take their piggy bank in, right? Financial education, all these positive things, saving habits, etc. There's a woman. There are two other women in line with me on this Saturday morning. The woman's going to the person in the teller, and they're starting a fight, and she's saying, "When's my check going to clear? What, Thursday? But I need the money now. Well, what's going to happen? I have debits coming. Well, what do you mean, $35? Well, is it per overdraft or free? What, that's going to be hundreds of dollars." And she starts yelling at the teller, "Put my money in, put my money in." The teller, I know the teller, what can she do, right? So I'm watching this going, I'd always been told that check cashing was a story of the unbanked, or the branch isn't open in a convenient neighborhood, or the times, or this or that. I mean, nothing could be further from the truth. And I'm thinking to myself, this payment delay thing, it doesn't affect me. I never hit zero on my lower bound. And then here's where the story I thought got really interesting and kind of changed the arc of my research. The other person in the bank, the other woman ahead of me in line, walks over to her, puts her hand on her and says, I can take care of you. What you need to do is go around the corner of the check casher, come back and deposit cash. And the woman goes, "When's the cash going to clear?" And she goes, "Instantly. It'll be in your account right away." "Oh my God, thank you so much, thank you so much. Where's the check? Where is it again?" And the other woman tells her. I thought to myself, okay, how prevalent is this problem? Maybe it's prevalent enough that I saw it once. But put it this way, there were 3 people in the bank. One of them had the problem, one of them knew the answer, and one of them thought he was a financial technology and regulation expert. That's how prevalent, 2/3 of the people in there, right? $35 billion a year in overdrafts, right? And was this an economically rational choice by her? 110%, $20 for the check casher, $35 per overdraft. Why in the world does our financial technology take a check on Saturday and clear it on Thursday? That's a fintech problem. And that's a problem that's affecting real world working people on a day-to-day basis, draining billions of dollars out of the pockets of people and putting them, frankly, to the wealthy.
So Aaron, how do you define that consumer class?
So I define that class as all of us who do payments, but I define it as the people would most benefit from this are the 50% of people that I say approach the zero lower bound of their bank account. And that is the people for whom days are a matter of serious economic consequences in the time period. So I use a zero lower bound of their bank account in part because I'm trying to reach an audience of one who has the power to fix the problem, the Federal Reserve, who spends an inordinate amount of time thinking about monetary policy when it reaches zero, what they call the zero lower bound, and way too little time thinking about what happens to people when their bank account hits the zero lower bound.
Any idea how many people we're talking about?
So this becomes more challenging, but I can tell you
It's millions.
$35 billion a year were paid in overdrafts.
Billion.
Right? Billion.
$35
billion a year. And I'm not counting late fees. You have check cashing. The FDIC did a survey where they found 7% of Americans are unbanked. 20% of Americans are underbanked. That is, they have a bank account, but they use a check casher, a money transmitter, or a payday lender, right? So that means that 1 out of every 5 people with a bank account fits into one of the, is possibly in there.
So it's the unbanked and the underbanked.
To me, the underbanked is a very, very, very large part of this story. It's 3 times the size. And we have these, was it $7 billion a year? Mike knows the figures better than I, in check cashing fees, right? If I told you we spend $7 billion in check cashing, I bet the first thing you guys would say was we need to get free bank accounts for everybody. Because you assume these are people without bank accounts. Oh no. Oh no, they're people for whom the bank accounts don't provide the service at an effective cost price point for many of them.
Theo, you follow some of the innovations in this area. What's happening to address some of these problems?
So it's interesting, Aaron, you mentioned, that whole process of, trying to get banking services, right? Which I think it's partially what T-Mobile is trying to do, the T-Mobile money, which is interesting because there's this whole discussion about what is a bank? What is banking services? Do we actually need a bank, right? If I am already a T-Mobile customer, I have, cell phone service, and I go say, hey, I'm putting in my money in with you, and by the way, I get 4% interest. How cool is that? I've been a customer of a certain big bank. I'm not going to say who, but let's just say, they've been trying to sell me CD at 2.5%. It's going to lock my money in for 2 years. I'm like, why do I want to do that? And I have my small business account with them. I have my personal account with them, and it's painful just to move money around to get services. I ended up having to write a check out of my business account, take a picture of it, and deposit into my personal account. We were talking about 2019 in here. So I think there's a whole lot of things that, from a technology perspective, we need to do better. And it seems, some of these are unique to the U.S. U.S. is, I believe, one of the countries that writes the most amount of checks. Whereas in China and Southeast Asia, they're paying with biometrics. Smile, and here you go. You get the barcode payment. So I think that is a big untapped area. But then going back to another area that, I started the company with, founded on, is the 115 million of Americans that are aged 50 and above. Now, someone yesterday asked me a really, really interesting question. He said, these people already have money in the banks, right? 70% of bank deposits are owned by people aged 50 and above.
Right.
Why do we need to do anything for them? They already have money in our bank. And I think that's what a lot of financial institutions think about is, I already have their money. I want to go after people that are not banking with us. But my question to these banks and credit unions will be, sure, they do have money with you, but have you thought about, are there things that you can leverage technology to help them plan better, to help them save better, to help them budget better? Are there things that we can use technology to do to help them safeguard their assets. Just because they have the money in there doesn't mean, okay, thank you, here you go, I'm going to wait another 30 years and you're going to transfer the money off to your kids and grandkids and off you go, right? Because I already have you in my pocket. There are a lot of things that we can do from a society perspective. I'm not going to like all of the challenges that we have, in the economy, which I think has been covered, like you say, for the last few days around, healthcare costs and, retirements, whether or not you're ready and not ready. But areas I'm fascinated with is using AI for wealth management, right? Because our obligations, financial obligations, are so much more complex than how it used to be. We need to think about how do we plan for our aging parents? They need to go to nursing home probably or get home aides. How do we plan for helping our kids for their college education? Maybe not the whole thing, maybe a little bit. How do we plan for our own expenses and all of that? So when you start taking in all of those data points, unless you're an Excel spreadsheet wizard, which I'm not, we need some sort of tools to help us make better decisions, and technology is a way for us to lower that cost.
I think we could find you an Excel spreadsheet wizard somewhere here in the Milken conference. I have a feeling.
I am pretty sure.
So Theo, all these emails I get, this guy is going to solve this problem. I mean, there must be some good new products out there. What are a few examples that you've noticed?
One of them.
Talk about it. Go ahead and talk about it.
Yeah, so there are a couple of different areas, right? We talk about saving, we talk about planning and budgeting and safeguarding assets. One of the things I always talk about is technology should be age agnostic, right? Just because you turn 50 doesn't mean you stop saving. Just because you turn 60 doesn't mean that, I'm just going to go down to Florida and, I don't know, golf for 30 years. So, in terms of wealth management, one of the ones that I like is called Peffin. They're based in
Puffin?
Peffin.
Spell it.
P-E-F-I-N.
Okay.
Yes, so they use AI in wealth management, particularly addressing the challenges I was talking about. When you have multiple different scenarios, how do we go about planning our future based on life events, life stage, right? Instead of arbitrarily saying, I'm going to put $400 away and let's see what's going to happen when I turn 85. And then there's another company that I really like.
Let me just ask you about Peffin.
Yes.
Is that targeted at an age group or a demographic, or it's everybody?
Nope, it's
so
everybody.
You would enter information, how old are you, what's your income, and so forth?
Well, more than that, actually. It links all of your accounts and your assets together. For example, you can do scenario-based. I say, my kids are going to go in college in 15 years, and this is the zip code or state that they might be going to. And it will take into consideration all of your balances, account balances, what you have, and it will continuously update the model and say, you're on track, or this is what you need to do, right? And this is what we need, because we can't do things based on a particular point in time and then go back a year later and say, oops, we're off target. We need something that can continuously help us. And that's where I think, technology will be really fascinating to do. So it's a lot of number crunching and algorithms. So that's a good one. Another one I really like is Liz's company that uses technology to help detect if there is financial exploitation, right? We all know that seniors get scammed, but not just seniors, right? Everyone can get scammed. But per episode, they lose over $100,000. That's pretty much the entire retirement savings that these people have.
Well, Liz, since you just got a nice endorsement there, do you want to tell us about your company and where did it come from and what is the need?
Sure. And as you said, I'm a former prosecutor, so I spent 30 years in the Manhattan DA's office, headed domestic violence, and then noticed we had all kinds of specialized units focused on different types of victims, child abuse, sex crimes. We had a gun trafficking unit. We had no unit focused on seniors. And I felt, and the DA at the time, Robert Morgenthau, felt we needed to create an elder abuse unit. Quickly saw that the most common form of elder abuse, which those of you who are interested in this, is financial. So not a huge surprise, but the cases I saw were extremely frustrating. Okay, so Theo talked about the loss per victim. It's $120,300 per victim. It cuts across all socioeconomic lines. You may think, well, the folks who have money, they're not scammed, they're not defrauded, or it doesn't hurt them so much. But actually, elder financial abuse, if you look at all forms of elder abuse, it has the lowest survival rate, highest mortality, even compared to physical abuse cases involving older victims, even compared to cases involving domestic violence. So it's tied with caregiver neglect, And I got very frustrated by the fact that my unit was growing in the number of cases we were prosecuting every year, because I love old people. So always have, and I wanted to do more. So at some point, it was actually after a trial I had that got a lot of attention involving a very wealthy woman named Brooke Astor, who lived in New York City and was exploited by her son and a lawyer. I got a call from a gentleman whose mother had been exploited. He was from DC. It was a typical case. We couldn't prosecute. He mostly wanted to find out why his mother's broker, who knew him, hadn't told him about what was going on with his mother's finances.
How was he exploited?
She was sold a car club policy, an auto club policy, when she was about 80 years old. She was a single mom at the time, probably had pre-dementia, probably had mild cognitive impairment, didn't own a driver's license and didn't own a car. Basically said yes on the phone. And this is common. I'm sure we've heard about these cases. And so didn't truly
Not by her broker, just by somebody who...
Just by an auto club service. Actually, a big company that's doing quite well right now.
You can tell me what company that is after.
Yeah, we'll tell you later. So, all of her finances ended up being affected. And by the way, this is a big issue for caregivers as well. When we talk about dealing with aging issues, I was in a great panel that Nora had yesterday, we need to talk about community. And we need to talk about younger people as well and forming a team to keep an eye on our seniors, right? Because kids no longer live next door to their older parents anymore, and they can use technology to keep an eye on their parents' money quite easily. Why we're not doing more of this, I'll never know, but that's something that we do. So the challenge that I saw as a prosecutor, there were a few challenges. One challenge is the fact that banks, investment firms, credit unions, they are not looking at your accounts in a macro way, right? They're not analyzing and looking for fraud across accounts or across institutions, but that's what scammers do. They're smart. They know what structuring is. So they're not going to take, $100,000 in one fell swoop. They're going to take, a little bit here, a little bit there, maybe use a stolen credit card, maybe form a fake identity that eventually lands in your credit report. But they know how to steal and fly under the radar, so banks and firms and credit unions aren't catching them.
Liz, could you just sort of categorize the most prominent types of elder financial abuse? So I think probably we all can imagine the scammer calling up on the phone and kind of just convincing you to give up Social Security. So there's people who would sort of just outright scams. They're inside jobs, right?
Yep.
I mean, that was part of the Brooke Astor story, I think, right?
Yeah. A lot of family
There's identity.
caregivers.
So just briefly, what are the categories of elder financial abuse?
Yeah, well, there are a few categories, and it's really variations on a theme, and probably you would know a lot of these. So the most common scams I saw as a prosecutor and now working in fraud monitoring are things like, we call it the grandparent scam, where someone calls up your older parent and pretends to be a grandchild or a friend. It's not always a grandchild in trouble. Mm-hmm. And the scammers are so good at what they do. I'm a veteran prosecutor. My father was called. The first thing the scammer said was he knew his name. Why? Because my sister and I were so bright, we did a Facebook account for him. There's so much on social media we have to watch out for. So I said, hey, Grandpa, it's Sam. Well, how did he know it was Sam? Because we had it on Facebook. The first thing the scammer said was, please don't tell Mom, Grandpa. And that's really smart, because every grandparent wants to be closer to their grandchild. Now, my dad didn't send money. The grandparent scam is huge. The IRS scam, where someone calls pretending to be from the IRS, you can name your government office, right? Could be Medicare, could be the IRS, could be we're the police and you have an old lien and we're going to arrest you. Those are common scams. Some of them are on the internet. Click this link. So they're all quite common. The other challenge I did want to mention is not just how scammers steal across accounts. I wanted to mention how caregivers, family members, are not doing enough to monitor. Okay? Banks and firms will not send, generally, alerts to you as the son or daughter of a senior, okay? Because there are bank privacy regulations. So I think tech can be very useful in sending alerts to family members who don't live next door to mom or dad anymore. So I just wanted to put that in there as, I think, a way that tech, as you asked Theo, could really be important. It's there. You can be a kid that lives in California or New York. Your grandparents could be, I'll choose Florida, right? And if there's a problem, not necessarily with fraud, even with buying food, wouldn't you want to know if your 85-year-old dad used to spend $300 on food every month and now was down to was down to 200 or 150, that could mean a problem with dementia, with depression. So I'm all about technology now. That's why I left the DA. I don't think fintech and aging are used enough in the same sentence. And there's so much more that could be done using simple, easy-to-use apps.
Yeah,
Mike-
and I think I want to add to that too is a lot of times whenever we talk to people about fintech and aging, right, the first reaction I always get from VCs is, oh my goodness, we're not interested in old people. But what a lot of times people fail to remember is that when we're talking about a circle of people that's taking care of the elderly, they're not all old people. A quarter of caregivers are millennials, right? And so when we're thinking about using technology, those solutions are not aimed just as what people's bias will be 85-year-old grandmother sitting in front of the computer. You are actually looking at a very, very broad demographic of Americans that can use technology to help.
Mike, can you help us focus in on what matters most here? So we're, I mean, when I think of fintech and what it does for different types of people, so I think of millennials. They understand the technology better than we do. They might have too much student debt, and they might not be able to get good paying jobs that help them pay that debt. But they understand the technology, and then it changes as you go all the way up to older adults, which we're talking about. What is the most important stuff to focus on here?
So first of all, following up on a couple of themes here, there's financial revolution with fintech. I mean, it is fundamentally changing this market, and appropriately so, because finance is inherently a digital industry. But if you look at major players, for example, I'll cite two of them, you've probably seen their ads. Take Quicken Mortgage. They have defined themselves as a technology company that happens to sell mortgages. But their management is, we could do almost anything. We have this technology platform, we use it for mortgages. You take Cap One, you see their ads. A fifth of the people who work at Cap One work in their IT. And there is, artificial intelligence is at a major inflection point, not merely a growth point. And it will be used in decision making across our lives, health, finance, everything. And finance is a key one, and appropriately so, because to pick up on Theo's comment, a lot of this is incredibly complex. And let me give one that is just a classic situation for elderly folks. There is, as most people know, a great shortage in retirement savings among those hitting retirement age. If you look at it, about a third have no retirement other than Social Security, so that's all they will have. About 20% have defined benefit plans, which are a vestige, and that number will keep going down. The rest have some savings in a 401k IRA, but it would pay an average of less than $700 a month on a sustainable basis. So huge shortage. The positive side is with the recovery of the housing market, there is $10 trillion in equity in people's homes. That is, that dwarfs the amount of retirement savings by about threefold. But one of the most complex and subject to abuse transactions is one that in a lot of ways makes sense, is a reverse mortgage, where you get to tap that equity in your home. These are heavily marketed. Watch TV at night, or if you've got older parents, they have been solicited, I guarantee you. And then it's combined many times with the purchase of an annuity. So that is, you take out the home equity, allow the person to stay in the home for the rest of their life, and then it's taken out lump sum and put into annuity. And you need more than a good spreadsheet to figure out how much money you get out of that, how much fees, and then there are also things, there's a huge problem for right now. Most of these loans today are insured by the federal government through FHA program, because that's the only place where there's a secondary market, but they have a horrendous foreclosure rate on them. So for example, people aren't told, well, you still have to pay the taxes, and no one has set aside the money for that, and if you don't pay the taxes and insurance, you can lose the house. Another thing they often scam here is you can take out more money if the reverse mortgage is put on just one of a couple, because the odds are you're not going to have the people living there as long. And so you've had this huge problem with one member of the family dies, and then now the house is supposed to be sold because it was more profitable to structure it that way. And then finally, we'll get back to this, there is just this huge financial divide that that Aaron has hit so well, and it deals with timing of payments, but it also has just a huge racial component. So right now, if you look at wealth, and you're going to need it going into retirement, families of color were just devastated in the financial crisis, particularly with home equity, and they, unlike white families, have not recovered to near the same extent. So today, black families have a tenth of the wealth of white families, and we're talking about the average wealth. We're talking for white families $175,000. So you're talking under $20,000 for black families, under $18,000 for Hispanic families today. And if you look at home ownership rates, white families likewise have recovered are around 72%. Black families under 43% and not improving, and that dropped by about 15% as a result of the financial crisis. So these issues also have to be looked through that huge racial income and wealth divide lens.
So Mike, those are underlying economic issues. What's the role of technology here? I mean, technology can maybe help with some of this. It can probably open up more opportunities to cause trouble. I'll give you first crack at that, but how do we think about technology helping address these problems?
So it helps in huge ways and has huge potential. We talked about the health. Now it's commonplace for everyone, but particularly elderly patients, to have remote automatic health monitoring. So for diabetes, for heart issues, where you've got a pacemaker, it's automatically sending signals that go to your doctor's office. And I mean, those are extraordinary advances. The monitoring, some of the things we've talked about here, the monitoring of counts, the planning of very complex decision making here. On the scam side, I mean, going back to overdraft is one example, was technology that was sold to banks. So they offer you free checking, but have very high overdraft fees and more than pay for the free checking, several-fold. And just to give you a number, so the FDIC studied the average low-income household who is a high-frequency overdrafter is paying over $1,200 a year out of a $20,000 income on overdraft fees. You ask, how can that happen? That's maybe 3 or 4 overdrafts a month, $35 a pop. They have limits. Many of them limit you to no more than half a dozen per day. But so there, it's making the problem worse.
Okay, so this sounds. Let me just ask. We'll broaden this up, but let's take overdrafts as just one example. This sounds like a market opportunity. If banks are causing this problem or they're not helping solve the problem, is anybody stepping in and addressing the problem?
Well,
Yes.
Yes, some of which are banks, because the underlying core problem is this incredibly antiquated payment system, and it's not just paper checks. Right? I actually wrote the law that allows you to take a picture of the check, because before that law, you had to physically fly the check and present it. And in that law, one of the things we failed to do was to mandate lower holding times for all transactions. You know, under the law, the bank doesn't have to give you cash in your account till the next business day, right? There are all these things. Now, the law, people here...
When was that law passed?
The Expedited Funds Availability Act was 1987.
You mean
And
before
Check
this?
21.
This
No,
law
Check
was,
21, the one about taking a picture of your
Yeah.
check. Check 21 was 2002. It was only passed because of 9/11. The planes were grounded for a week, and back then the Federal Reserve, who proposed the law, did a great job in that. But they retained the sole authority to lower your check clearing time of every. Who here thinks direct deposit is instant? Because you're wrong.
Not in the U.S. Yeah.
Right? In Europe, you can deposit a payment in Portugal from Latvia faster than you can cash a check from Minnesota to Florida, or any payment.
Yep.
It takes a day. It takes a business day.
and that's not because of any practical limitation.
The United Kingdom developed real-time payments when the first iPhone came out. I mean, the technology is very well there. And frankly, a group of banks have instituted a real-time payment platform, not out of the goodness of their heart, I think, but in large part, they don't want to be the taxi medallion business when they see Uber come, because as Thea pointed out, China, there are no payments in the banking
Okay,
system.
worthwhile digression. Do the banks, are the banks actually making money on the float? Is that, I mean,
No. The
for
float
one
isn't the
day's
game. It's
worth
the
of delay?
overdraft. It's the overdraft. It's not the float. People think it's the float. Interest is very low.
Yeah.
And, the banks are on both sides of the ledger, right? Getting the payment faster and getting this. They have a $35 billion industry. Here's...
So let me just get this right. So banks actually process money slower than they could so that people will overdraft
not just
and
banks.
they will make money on
It's
that?
the Federal Reserve. The Federal Reserve runs something called the Automated Clearinghouse, ACH. It's a system within the system. The Fed, here's the problem. The Fed, as the government, was tasked with regulating a system, but they also operate. And their operation system is deeply slow. It runs on outdated technology that can't be easily modernized. It's a batch system, if you want to get into the Excel wizard sheet. And here's the problem. They've been trying to, rather than bite the bullet and do what other central banks all around the world have done, they haven't done it. In fact, they created a faster payments task force. They put 332 people on it. Right? Only in a Kafka book would 332 people try to come together to do something faster. And they won't use their regulatory authority because their operation system couldn't comply.
But there are apps that can warn you if you're headed towards an overdraft.
Right?
And if we're talking
they're
about...
helpful.
Yeah, so let's go
using
back
tech-
to who's
So they're-
solving this one problem, the overdraft problem.
T-Mobile money.
No, the banks. the
banks.
banks have a real-time
Thank you,
payment
too.
system that goes on right now among the 48 largest banks. And they're starting to roll it out because the Federal Reserve isn't acting. But it's a problem because everybody has to join the system, right? Because I have a small credit union, right? It's going to take a while for this adoption, right? We have 12,000 different institutions. They all have to be networked. And frankly, it's hard to run 2 or 3. Europe actually has 2 competing systems, which makes it a little more challenging because dual operability.
And this really raises one of the core dynamics here, and that is the tension between the fintechs and the banks. So the banks are smart enough. Most of the major banks see their biggest competitors and threats are not the other banks, but are Amazon, Microsoft. Amazon, by the way, is scheduled to come out with a checking account very soon, which will be a major test of market disruptions. But today the tension has been in the banking system. It is heavily regulated, and the fintechs have not had access to the bank charters. That's changing. There's an experimental program that's being challenged and all that going on now.
Or to open APIs.
Right, but
What does that mean?
apps.
Application program interface.
Yeah.
So that they're not making them. I won't say all financial institutions, but most aren't making this data readily available to fintechs that could use it to create systems like we're talking about that could warn about an overdraft.
Or-
And by the way, take a look at a company called Dave that would be.
But let me take
And if I can finish really
Okay,
just
sorry about
so
that.
the key battleground is, and the Dodd-Frank Act passed in 2010 tried to address this, is who owns your banking data. So Congress tried to help this by saying it's the consumer's data, and there are a whole host of fintech companies who try to access that data. They would like to do it directly. Today, in sort of an archaic way, they actually screen swipe it. They get your code and go over there and screen swipe it, re-enter it into their systems so they can interact in the bank. And one company is actually trying to address overdraft. If you sign up with them, if you're approaching an overdraft, they will put money into your account to avoid the overdraft. The overdrafts are so excessively priced, it's quite lucrative for them to deposit that money, give you a loan, and cover the overdraft, and they can charge
And the
you a
consumer will
fraction.
end up paying less.
Yes.
So
Liz, you're getting fired up down there.
Well,
Let's-
yeah, I would argue that it's the consumer's data, and the consumer has a right to consent to the access of that data to make their banking more efficient. And we use consumer consent to have accounts linked to.
let me ask you, and I'll ask everybody in the room here, because I may take the less popular side of this, but there's would you consent to giving up your real-time geographic information to one of the largest companies in the world for no monetary benefit?
I think a lot of times.
Haven't we done that already?
It's called Google Maps.
Right.
Does anybody really know what you've consented to in your iTunes agreement? This idea that we're going to rely on consumer consent, especially when these apps say they're free, right? A lot of this screen swiping is to get advertising data to sell to hedge funds.
And some of it is used by aggregators to provide great services to
Correct.
consumers that banks and firms and credit unions aren't offering right now.
I love Google Maps. It saves me
I love
2
it too.
minutes a day, right?
Right.
I let Google read my email, right? But I also have no idea what I've consented to in my Apple. And when you say it's a consumer's data, right? You know, I think what is it? Some of the fintechs, 3% of customers are 50% of the data requests for banks because they're logging on to your account 50 times a day and screen swiping all of your stuff. Oh, look, oh, you just charged something. You must be at the mall, right? I can infer when I piece together these pieces of data, a lot of information about you. And
By getting information from an open API would avoid screen scraping. So in many ways, you could argue that it's safer.
Well, it is though, but I would caution on putting too much on open banking. Look at what happened in Europe. They've implemented it for over a year. And essentially what they're doing is they're saying by law you have to open up access of your data to these fintechs so they can provide services. A year plus later, what happens? They're like, sure, we'll give you access, but we're going to make the experience so clunky
Correct.
that the consumers just didn't want to use it, right? And so I think that, and plus who owns the data, that is a much larger, broader question that needs to be addressed, but is nevertheless, if done right, is a big if, I think it can provide good use. For example, going back to what Michael was saying, you know, with health, right? If somehow an entity can get access to my health data, also my financial data, you can, theoretically speaking, correlate that data and figure it out based on your health conditions, based on everything that's happening to your life. This is how I think you ought to be doing when you're coming to planning your next 20 years.
Guys, I want to talk about seniors a bit more, and just for the audience. So we've got about 20 minutes left, and at about the 10-minute point, we will take some questions if you have them, very short questions, so think those up. So let me talk about seniors and technology. So we think, I mean, the sort of common perception is that seniors are not as adept at technology as younger people. I mean, that's true to some extent. My own mom is 76. She might be watching. Hi, Mom. She's a smart lady, but she's not real comfortable with certain things on her smartphone, and she just doesn't really want to get involved in new things on her phone. So first of all, if we're talking about new technologies to help safeguard seniors or help their family members kind of keep track of how they're doing and stuff like that, is that a problem? Are the fintech companies addressing this? And since I think we're talking about kind of like multi-generational services where it's not just the older adult using it, it's the whole family that might be using it. What is the right way for companies to address this, and are they doing that?
So I can take a first crack at it. So there's a company called Golden, right? They're based in California, and what they do is they do quote unquote financial caregiving services, and essentially is they are providing service to offer to multiple family members to help them take care of their parents' finances. One of the things is looking through all the subscription services, seeing what can be renegotiated, looking at what benefits the older adult can qualify for, and all of those things, right? And what I love about them is Evan started the company because he went through that exact same episode. When he was trying to take care of his mother, she was in the hospital. All of a sudden, he is in charge of all of her money. He was like, okay, how do I start? Where do I start? And he ended up spending 9 months trying to figure out what services she has, where her account, what's going on. And so he said, there's got to be a better way to develop this. So therein is a great use case of looking at how can we leverage technology to service multiple generations. And he has use cases and studies where, he was able to help the family save X amount of dollars.
Yeah, and in my case, I didn't finish this story, but the gentleman who called me, whose mother had been exploited, is my CEO, who really was disturbed that his mother's broker hadn't contacted him about what was going on, because really her life savings were really compromised. And I explained privacy and how, even if you go to the bank and ask to get a copy of a statement and you're a trusted child, you can't get it. There's something called a suspicious activity report that's filed on all of you. If there's suspicious financial activity that's filed with the FinCEN database, but you won't get a copy of it. So we figured technology could do this for consumers, and we work with banks and firms as well. But there are Golden is a company that does this. There are simple ways that fintech can help. keeping seniors more independent at home might involve an app that, and there are a few companies that do this, will give them a prepaid debit card. So if there's a senior that keeps going to that corner store to get a green dot card because she believes there's a Nigerian prince or she believes she's in trouble with the IRS, that prepaid debit card can give her independence and control without taking away her money, without making a joint account, which as a former prosecutor is really just a nemesis for prosecutor, without creating a POA where you have access to funds and can give yourself gifts that really shouldn't be authorized. You can get in, there are a few apps out there that will stop robocalls, which get a lot of seniors in trouble. I don't want to generalize, but I think older people are generally more polite than younger people. They don't slam down the phone, right? And it's nice.
They're learning.
Right, and they get in trouble. And there are laptops now that are simpler for those seniors that do have some trouble with tech. And by the way, many of them don't. You know, the boomers are aging, and a lot of them are great on tech. My dad's in his 90s, and he's really quite good at technology. So I think there are a lot of ways. Bill paying services. There's one called Silver Bills that uses technology to pay bills, which can get some older folks, not all of them, but some of them in trouble with fraud. So I think that there are very simple technologies that exist and can be created to deal with this problem, again, from sort of a macro view.
So let me jump in because I also think there's some legal impediments, and you made me laugh since we're sharing personal stories.
That's good.
So I had a SAR filed on me.
Okay.
We have a very close family
That's
friend.
a suspicious activity report that I mentioned.
Right.
Okay.
So we have a very close family
I
friend.
wish we'd known ahead of time. We could have got that for the panel.
They're very secret.
Figured out
I don't
what
know
you
how
did
you
wrong.
found out because they don't give you notice, but
No, they don't. But the bank teller told her. So she's wonderful. But she's mild cognitive impairment. She's divorced, no children, no siblings. And so, I was coming in to help her with her financial situation. The law, I put myself on a joint account so I could pay some back taxes that were starting to accumulate. And then in a fit of confusion or something, she paranoia, went and took me off her account and this or that. And the next thing you know, the guys did that. But here's what also happened, and this was devastating.
this is getting really interesting.
I got to be careful with the prosecutor here. X. Good. Here's what's really interesting. The guy then said, well, look, the best thing you can do is we're going to close your account and create a new one. Great. Okay, sure, blah, blah. Just want to take me. So what happens? Well, her pension goes to her old bank account. Her Social Security goes to her old bank account. All of her auto bill pay that I'd spent the last 3 months setting up.
Yeah.
And it was the closest thing you could come to financial suicide
I-
for a person in that position. And I'm thinking to myself, out of the flip side, I'm thrilled that the guy filed a suspicious activity report on me. The CFPB showed that those have increased by fourfold. I think there are 68,000 of them. There's still more suspicious activity reports filed on pot banking, which is super silly in my opinion, compared to elder abuse, which is a much bigger problem. That's fine. In 6 years, somebody will probably get to it and read it. What I think was really bad is nothing happened to the bank teller who created a new account. Maybe he got a bonus for creating a new account. I don't know.
Well, we've heard about problems with
Well, what
unauthorized account
should have
openings,
happened?
so-
Should the bank
They should
teller
not-
have
they
flagged
should-
that as a...
They should not have closed her account and opened a new one with the direct debit of that situation. But I will say, and I have a lot of sympathy for them, I don't know what should have happened because I'm not legally empowered to do anything for this person. I'm not legally, they never told me. I found out 3 weeks later when checks started to bounce.
Well, guess who the number one percentage of defendants on elder financial abuse cases are? It's not strangers, it's not the scam callers, it's relatives. So probably the teller got training. There's a son coming in trying to do X, Y.
I'm unrelated, and this is the thing.
What's that?
I'm unrelated, and
I thought it was your
a family friend, no children.
family friend.
And this is part of the problem. We have a legal structure that's defined a series of relationships for people under the assumption that we're all married with children
Right.
as we age. And an increasingly number of people, whether it's because, per Mike's point, they become a widower or widower,
Is this a
but they
senior
don't
event?
have kids.
I missed this part. Okay, but a family friend.
I want to get through a couple other lines of questioning here. It's a good conversation, though. So at Yahoo Finance, we talk a lot about robo-advisors. And we have people who think they're great, and we have people who think they're terrible. And there's only going to be more of this with artificial intelligence coming on. So what should consumers think about robo-advisors or these automated, I mean, I think that's probably some of the services we're talking about here. What should consumers think about this?
I think it's much more the source than the method of providing the advice. There's a lot of pretty clear evidence that across a wide range of things, artificial intelligence is better at decision making, whether it's reading health results or making complicated investment. I mean, it is designed to answer questions that take a lot of number crunching, and you need a lot of data. This is all complex, and I think this is it, is what people are looking for is a trusted source. I mean, like talking about the home equity loan, reverse mortgage, you can be scammed by somebody with robo-advisors or automated investment planning where it plugs in the input and gives you a plan at the end. An automated system as compared to an individual investor taking the information using his or her expertise to give it. And again, those things are good, but it really is finding the trusted sources.
How do you do that? How do you find the ones that are trustworthy?
I think that's a constant struggle, right, with a lot of these fintechs at what they're facing. Doesn't matter who they're servicing, right? It could be older adults, it could be younger adults. The question always comes back as, why would I trust you? Who are you? I don't know you, right? And so I think that's where there is a lot of opportunities for banks to work with them, because banks.
I mean, banks are at least name brands.
They have their brand.
They've been around for
Exactly.
50 or 100 years.
Right?
Yeah.
So they have the brand, they have the trust. In a lot of cases, people say, oh yeah, I can go down to the street and, Mr. Jones is right there. There are a lot of opportunities where banks can partner with these fintechs and provide better services, right? So for example, one of the startups I work with is called Envo. They're rolling out later this year where they're using AI to understand, based on historical data, based on your past spending, to develop what they call a DNA, a spending DNA. And then from that, using that insights to automatically partition, just like the old days when we do envelopes, right? Putting cash in different envelopes. This is like their way of saying, okay, based on my understanding of what your expenses are, based on my understanding of what your income is, this is how much I'm going to partition off for you to pay bills next month. This is how much I'm going to partition off to help with your short-term savings, because that's a big problem, right? With our society, half of Americans don't save or doesn't have more than $400. And then they will also partition of a save-to-spend bucket. So you don't feel like, oh my goodness, every month I have my paycheck coming in and all I do is off you go, pay the bills and pay the student loans.
So who's doing that?
It's a startup called Envo. ENVEL. They're based in Boston.
Envel, yeah.
So those are opportunities, and they're not doing it alone, right? They're not trying to be a neobank, but they're trying to provide services on top of a banking entity, right? To help consumers do better. And that's a classic example of how they can work together. Because as a consumer, I'll be like, I don't know you. Why would I want to give you all this data? Why do I want you to manage my money? But I know my bank. I've worked with them for 20-some years.
So as a precursor to getting some of these services in place for older adults, if it is, let's say, a family member, should everybody should everybody have their accounts online, automated bill pay? Because that is kind of a self-organizing way to put all your accounts in one place. And at least if you end up having to kind of take care of a parent, you can at least see.
No. So here's the thing. It depends how much money you have. When you do automated bill pay, you're committing without your express, right? I'm going to pay this all the first of the month.
Well, you can also set it up that you link the account, but you make the payment, right?
Well, then it's not so automated. Then I have to remember to go.
Well, okay, so I'm using the wrong word then, but
I think with
you can
all
have electronic
automation,
bill pay, I guess.
with all automation, you need some human oversight, right? So I believe in automatic bill pay, and I believe it's actually safer to have accounts online than to use brick and mortar bill.
And mail checks. I mean, a lot of people still put checks in the mail.
Yeah, a lot of folks do. As a prosecutor, I saw far more problems with seniors at banks than I did with those who had online activity.
So, but let me.
Online.
If your
online
bank
banking.
account always has money, then it's a great thing. If you are managing from paycheck to from income in, which is becoming increasingly variable, right? A lot of people in retirement, because of all the points Mike make, they're driving an Uber, they're still working, right? We're thinking about seniors, right? And they still need that income to live. And as that income varies, if you fixed your expenses on a calendar basis, life becomes incredibly expensive. So we have these ideas that we can automate things under this basic kind of core premise that the money's always there.
So you're just talking about automated banking, and I was thinking more in terms of safety online. And I think there's a misconception that if you don't have a lot of money, you don't have a lot of money in your bank account, then you really shouldn't have online banking. Where really online banking can really warn you about whether someone else has phished, gotten your personal information, has set up their own account online in your name and opened up a new. So I think we agree on that one.
And there are apps
Hold that thought,
will
Mike.
address that.
Hold that. We're going to get to you. If anybody has a question, tee it up and find the microphone, please. Go
We
ahead.
were told to converse and argue a little bit, lest you think any of us is being obnoxious here. We wanted to make it.
We're not throwing too many.
There are
Right.
apps that will say you have a bill due in 2 days.
Right.
Punch here if you want to pay it out of your account. And so it sort of marries the two of these systems. And
Yeah.
those are useful, particularly for people. This float, I
Human
mean,
oversight.
if you ever want to see how much this float is, go into a Walmart.
Which float are you talking about?
Of how much people have to balance their money.
Yeah.
How many people go into Walmart at the end of the month on the night before Social Security checks arise, and you will see people in the grocery division shopping with their carts, all milling around, and at 1 minute after midnight, they all hit the registers. It is such a big phenomenon that Walmart has to structure their staffing and their stocking around this, but they are waiting. They cannot buy the groceries until their Social Security check hits their account.
You know what I'm worried about is that I think from the last report I've just read, 35% of independent gig workers are boomers. And that number is going up, right? And so to your point is when your income is fluctuating from month to month, which is something that they're not used to, right? Because most of them are used to having a W-2 every 2 weeks you get paid. You need something to help you line up your fluctuating income to your expenses, which most part is fixed. You know, your rent is due on the same day every single month.
We have a question here, I think. Would you please identify yourself and just please keep the question short?
Okay, I'm probably the old man in the house at 84. I live and work in Pacific Palisades and Riyadh, Saudi Arabia. I have a charitable, revocable trust account, divisible in certain parts. The equity part is enough to get me into the private bank. Now there's an installment payable on that stock account, equities, all traded equities that I've owned for 40 years. Don't sell any of them. There's a charge for my custodial services. And there's no cash in my equities account, so they block all my accounts. That's one scenario that is just kind of terrible because I might not live around. Secondly, I have 3 daughters, one over 50, two over 20. I want to make them use my wealth without having to die first. And I want to put them on my accounts, except that they so live on Social Security, social networks, that the minute I gave them the authority, my God, I'd be.
So let me ask you to get to the question. You can
So
try to get
how do
financial advice after the
banks-
panel.
What should the banks do in the case where a $1,700 bill on a huge amount blocks all the accounts?
Well, but
Okay,
so
go ahead.
let me get to the core issue that's behind the issue, right? Which is that, as you point out, as a result of our tax system, you have a stepped-up basis upon which your equities that you've had for 40 years, and I'm going to guess from the rest of your question, you invested more in Apple and FedEx than in Sears, and so, right?
Cable.
So, so you're trying to use the tax system and not pay a very large capital gains tax in order to get liquidity. Okay, like That's fair. I get that. I also point out, we have a tax system for, the first tax we had in America was an inheritance tax. We had an estate tax before we had an income tax, right? And the ability to perpetuate wealth on a tax-free basis, that's not something that I'm in favor of. So your entire liquidity problem, which I get, is fundamentally driven by a tax system that rewards you for holding your investment.
I don't think this is really a technology issue either, right? Okay. Let's go to the question here. We're gonna take another question if you don't mind.
Thanks, Nora. Super. I'm listening with great interest. I work in the Center for the Future of Aging at the Milken Institute, and we want to look at fintech across all generations. As a mother, I'm a boomer. I have 2 kids who are millennials, and we often use Venmo. And people that I work with too. That's the easiest way to go. I'm always a little nervous about that. That's accessing my bank account, and it's out there. Is that something that works better? And then just another question too, the conversation about not having income flowing all the time reminds me of the government shutdown and how people really couldn't pay their rent and they couldn't do things. Is it better to advise my daughter to have an automatic payment that's going to make sure rent's paid on time that might result in a overdraft? Because I think it's a trade-off, right? When you're trying to protect your credit report, but you're also know you'll be charged fees to get money when you need it. And
Okay,
so it's
got it. It's 2 questions. So first about Venmo. Venmo is now owned by PayPal. So is Venmo trustworthy?
Well, I believe in monitoring your money, obviously. So I think if someone got a hold of a Venmo/PayPal account and there was a lot of unusual activity, you would see it in one of the depository accounts, probably feeding it, and eventually it could be flagged through the use of technology that's looking for unusual activity. I can't vouch for whether it's safe or not. I think you should always be careful. I think Venmo's like a way of life for, I don't know.
Yeah, I mean, plus PayPal, which owns it, has been around now for a long time. At least PayPal has proven. Anybody want to tackle the other question?
As for the other one, I think, the first thing I would do is look for banks with services that can alert you if, you will go into an overdraft situation. Because I think traditionally, a lot of banks, they are built on fees, right? That's their business model, is fees, overdraft fees, cross-country remittance fees, and all of those. So look for one that will flag you.
So let me just say, which of these 3 things do you think is the most secure? Right? That's really the question that you asked. If I don't carry a checkbook, right? So like that's the missing 4th, right?
Bitcoin.
What's your answer? What's everybody's answer? The phone. Yeah.
Right?
Does everybody agree?
This?
No.
No,
Cash.
absolutely
Cash.
not that one.
Older people like cash.
So it falls out of my wallet and anybody can get it.
Oh, yeah.
Interesting.
We have time for one more question. If anybody has one. If anybody doesn't, No. We're gonna share it. We're gonna share the microphone.
Yeah, I've got one quick question. Rick Edelman with Edelman Financial Engines. Are there any bankers in the room? There's a lot of bankers sponsoring this conference, a lot of bankers at this conference, and the fact that none of them are in this room represents the entire problem.
I can tell you why.
That's
Because there was a recent digital banking conference, and a question was posed to all the bankers that were in the audience. Pick out the segment that you're most interested in. There were boomers, millennials, Gen X, Gen Z.
And they all want high net worth, of course.
Yeah. If I can add one thing that underlies a lot of this is one of the things that fintech should solve, and it has in Europe, is in this country it is extremely difficult to move your bank account. And the banks have no interest in making it any easier. I mean, you better set aside the better part of a week to pick up all the pieces. And in our system, you need float, going back to some of our issues, to cover outstanding checks on the account while you move to the new one. So it's particularly bad for people with more variable and lower income. But that dramatically reduces competition. Like, no one shops at banks based on the cost of these overdraft fees, although they're a huge thing. And the banks have no reason to compete against them. It costs the banks probably less than $1. And some of the banks, in fact, some credit unions and community banks will charge you less than $1 for overdraft. 20 years ago, there were no overdraft fees. They would simply advance money out of your account or give you a line of credit at 18%, which resulted in about a 50-cent charge to cover this. But then they found they've got you in this very hard to move account, and they moved to the model that Theo talked about, and the analysts encouraged him to do this. Let's generate as many fees as we can off this account.
We should also consider the possibility that there could be bankers in the room who just don't want to identify themselves. Folks, we're out of time. That was a great panel. Thank you to the panelists.